Should you rather buy common stocks or invest in a house? Is it better to buy federal bonds or put your money in ETFs? Today, I'm going to show you a quick and pretty easy to apply tool that you can use to compare different investments with, the cash yield method. Hi, my name is Till and this is the channel that shows you how to invest intelligently and easily and how you can build up a fortune also as an ordinary person with a normal job. The cash yield takes the ability of an investment to generate cash for its owners and puts it in relation to the price. By this, it tells you how cheap or expensive an investment is. You can therefore use it for basically any investment that is generating cash. The higher the cash yield figure, the better. Another nice side effect is that it also provides you with a valuation of an investment. For common stocks, you take the free cash flow that the company is assumed to generate in the future and divide it by the market capitalization. Market capitalization is the price that you would pay if you would buy the whole company. You can basically read it on most of the finance information website, or you calculate it yourself by multiplying the number of outstanding stocks times the price of a stock. Let's say you want to buy stocks of the company Kellogg's. You look up the market capitalization and find out that as of October 5th, 2021, the Kellogg company had a market capitalization of around $22 billion. You analyze the future free cash flow and estimate that Kellogg's will generate around $1.4 billion free cash flow per year in the future. This is of course just an example, not a real estimation. $1.4 billion free cash flow divided by a price of $22 billion for the whole company results in a cash yield of a bit more than 6% that your investment in Kellogg would generate in this example. What's important to know is that the cash yield will go down when the stock price goes up and vice versa. Of course, provided that the generated cash is the same. This is also valid for other investments. Like for example a house or a flat. You calculate the cash yield for a house or a flat that you want to invest in exactly the same way. Let's say you want to buy a house as an investment and you receive an offer for $500,000. Number one, you take the cash that the house is expected to generate. So we assume that it will generate $25,000 per year in rent. And then, number two, we deduct all assumed costs of that. Let's say $10,000 per year. Number three, we then divide the generated free cash flow of $15,000 by our purchasing price of $500,000. Voila! The investment in this house would return an expected cash yield of 3%. When you compare the investment in this house with our example investment in the stock of Kellogg's, you'll see that the investment in Kellogg's would return a 3% higher cash yield. And the same you can apply for bonds, ETFs, mutual funds or any other investment. The cash yield may be a quick method, but I don't think that it is dirty. Especially as it puts the investment in stocks more into the perspective of a business owner. But you might ask yourself, what should I care about cash yield if I sell a stock for the stock price and not for the yield? If the price doesn't move, I don't make money. Remember that the stock markets are quite efficient most of the time. Not always, but usually. If the yield of an investment is high and stable, Mr. Market will lower this yield over time by increasing the price of the market capitalization and by this, the price of the stock. So, a high yield puts the stock price under pressure to rise. In a nutshell, the cash yield provides you with a quick way to compare different investments and to value a business. What it doesn't provide you is a business or investment analysis. And it is also not a tool to predict or estimate future cash flows. When you want to know how to do this, you should watch my 2-video mini-series on what free cash flow is and how you calculate it next. See ya!